trade selection now for these weekly covered calls, and we use 3 criteria for selecting ETFs for cash payouts. The first criteria is that the ETF trades weekly options. The second criteria is that the ETF option premium gives you at least 1 to 2% weekly cash payout by selling the at-the-money call, and that the price, and criteria number 3 is the price of the ETF is trending up. So what we're focusing on right now are weekly covered calls on ETFs, and this is a strategy we've been using for many years. So let's look at our trade selection. Step 1 is that the ETF trades weekly options. So, of course, with weekly options, you collect 52 cash payouts a year, and they expire every Friday. Now, you can find a current list of ETFs that trade weekly options on the CBOE website. That'll give you a list of ETFs that are trading weekly calls, and with monthly options, you of course can collect 12 cash payouts a year. The monthly option expiration is normally the 3rd Friday of the month, so even though you collect fewer premiums with monthly options, we do trade monthly covered calls on some ETFs that don't trade weekly covered calls. So we trade a combination of weekly covered calls for those ETFs that have available weekly options, but we also trade monthly covered calls on ETFs that don't trade weekly options. So criteria number 2 is that the option premium gives you at least a 1 to 2% weekly payout, and that's for selling the at-the-money call option. So the ETF's option premium, we want to see at least a 1 to 2% weekly cash payout by selling the premium, and our goal with weekly covered calls is to collect that 1 or 2%, at least 1 or 2% weekly cash payout. And if you do that, of course, if you collect 2% on average, over the course of the year, you're going to have 100% cash payout at the end of the year. And we sell an at-the-money call that's the closest to the current trading price of the ETF. So let's look at an example. The energy ETF symbol ERX was trading at $39.91 on Friday, December 30th. The at-the-money weekly call option that expires 1 week later would be the 40-strike call, and the 40-strike call would expire 1 week later. So if we wanted to establish a weekly covered call, we'd buy 100 shares of ERX and sell to open 1 40-strike call. So that's how we could initiate this trade, and the 40-strike call was trading at 1.10 points, so we got $110 cash payout minus the commission for selling the call at 110. And if you take the 110 and divide it by the cost of the ETF, $39.91, that comes out to 2.75%. So for that weekly call, selling that at-the-money weekly call, in this case, we get a 2.75% weekly payout. So the goal is we want to see at least a 1 to 2% weekly payout when we're trading these weekly covered calls. So on January 6th, the 40-strike call could be rolled over, and we would close out the 40-strike call and then sell to open the January 13th at-the-money call, and that would we would collect another weekly cash payout, and we would keep the ERX shares in our brokerage account. So to roll over this weekly covered call, we'd buy to close the January 6th 40-strike call, and we'd sell to open the January 13th at-the-money call. So we like to look at trading leveraged ETFs. The ERX ETF is a leveraged ETF, and it holds a basket of energy-related stocks, and it's a 3 times leveraged ETF. So the ERX seeks daily investment results before fees and expenses of 300% of the performance of the Energy Select Sector Index. So the leveraged ETFs move 3 times in relation to the underlying sector index. So the ERX would be an example of a leveraged ETF, and if the energy sector is up 1% for the day, then the ERX would be up 3% for the day if the ERX meets its investment goals. And conversely, if the energy sector is down 1%, then the ERX would decline 3% if it meets its goal. So the ERX is a leveraged ETF, and because of that leverage, these leveraged ETFs incur more risk than non-leveraged ETFs, but they have very rich option premiums with bigger cash payouts. So through our experience, we prefer to trade these leveraged ETFs. We collect more premium. They are more risk, but we collect more premium, and that collecting the more premium outweighs that extra risk associated with leveraged ETFs. So we like to use leveraged ETFs, and that allows us to meet that objective of at least a 1 to 2% weekly cash payout. And then the third criteria for selecting weekly covered calls is the price of the ETF is trending up. So that's our third criteria. And the covered call strategy in general is a neutral to slightly bullish strategy. So we realize the full profit potential for the covered call trade when the stock closes at or above the strike price of the at-the-money call option, so at expiration. So if we sell an at-the-money call, all we're looking for the stock to do is just close at that strike price. So it doesn't. We don't need a big up move in the stock for the covered call trade to be profitable. So we're just simply looking for ETFs that are in a price uptrend, and we avoid ETFs that are in a price downtrend when we enter these weekly ETF covered calls. The downward price movement of an ETF in a price downtrend can exceed the cash payout you receive for selling the call option. So we found it's just simply easier to just focus on the ETFs that are in a price uptrend. There's plenty of those available, and that reduces the risk of the price decline of the underlying ETF exceeding those weekly cash payouts we receive. So we simply want to see that the ETF is in a price uptrend, and for that, we just look at the 1-month price of the ETF in relation to its 10-month simple moving average. So we want to see that 1-month price above the simple moving average. Then we know that the ETF is in an uptrend, and we'll just simply focus on ETFs that are in a price uptrend. So again, we look to only trade these covered calls if the 1-month price of the ETF is above its 10-month simple moving average. Then the ETF is in a price uptrend, and we simply avoid those ETFs if the 1-month price is below the 10-month simple moving average. A very simple trend indicator. We just want to make sure the ETF is trending up before we initiate a covered call trade. So this is a price chart of the triple Qs. That's the leveraged NASDAQ index. This red and black line here is the monthly price of the ETF, and this blue line here is the 10-month simple moving average. So if we're going to initiate a covered call for the triple Qs, we want to just check this monthly price in relation to the 10-month simple moving average. And you can see right here the monthly price crossed above the 10-month simple moving average. So at this point, we could initiate covered calls, and as long as the 1-month price is above that 10-month simple moving average, we can initiate weekly covered calls. And we can get that 1-month price and 10-month simple moving average. That can be downloaded from stockcharts.com with the basic subscription.